Welcome everyone to today's webinar, proudly brought to you by ADDX. My name is Cheryl. I'm the Head of Issuer Originations at ADDX, and I'll be your host and moderator for today. Today's webinar is entitled Decentralized Finance, Establishing a Foothold Amidst Volatility and Uncertainty in the Crypto Markets. I'm very happy today to have with me from the Trovio Group, John, Dean, and Will Hamilton. John is the CEO and Managing Director at Trovio Group. Trovio was founded in 2017, and it is an established digital asset manager and advisory firm out here in Asia Pacific, providing services under the TCM brand. Prior to joining Trovio, John was the Managing Director and Head of Asia Commodities Trading at JP Morgan. He was based in Singapore, and he was also a board member of JPM Ventures Energy. Even before that, John was based out of London as the MD of a vanilla and exotic derivatives trading business. He was there for just under a decade and had a team based out in New York, Singapore, and London. Will is the head of research and trading at Trovio. He previously operated a privately traded long-short fund specializing in cryptocurrencies, equities, and hard commodities. He's been heavily involved in the cryptocurrency industry since 2016 and has a deep knowledge of its intricacies and strategies to maximize profit. Even before that, he worked at Pitt Capital Markets, the internal investment bank of the investment house Washington H. Saul Patterson, and at Ernst & Young as a management consultant. Once again, very good afternoon to everyone. I'm Cheryl, Head of Issuer Originations at ADDX. A warm welcome to our speakers and participants today. So John, can I perhaps start you off with the first question? Blockchain. What is it? Why is this innovative technology going to cause global disruption?
Sure, Cheryl. I mean, it's a good question, the first one, like what is blockchain? Because there's often a fair bit of confusion about blockchain and cryptocurrencies, and they generally get commingled. And then, really where we're going as I guess, an ecosystem and community that what's being built around blockchain and crypto. And really that's where a lot of the innovation is coming from. But in a short sort of sentence, really blockchain is a immutable set of data points that are hosted by millions of computers around the world. Obviously it's underpinned by cryptography, and we are leveraging now largely smart contracts to create entirely new, what I would call ecosystems that are very disruptive. That disruption is, at the most part leading towards DeFi, and obviously that's a large topic that we're talking about today, and traditional finance, which, as you mentioned before, is my background, both in the, I guess, real asset world, whether you look at it from commodities, real estate, traditional equities, credit, etc., all the way through to these new assets, which are obviously crypto. And how does crypto, define its value, and how you can generate different types of returns by being exposed to these markets. But for me, one of the biggest, most exciting points that I think is going to cause significant global disruption, and disruption in a positive way, is effectively what DeFi is forming today and doing specifically for crypto, and that is around sort of yield farming, staking, deriving returns from the disintermediation of central counterparties that have provided historically, really since the 1980s, a lot of services to financial markets to support really trust, right, for transactions. And the ability to leverage these smart contracts. And for people, we're obviously going to delve into it a little bit deeper, so I won't expand too much, but the ability for people to lend into these pools, for whether it's a crypto asset or a traditional asset, and derive a return from it, and the smart contract actually to be the intermediary that a bank, historically has performed, or insurance broker, or many other types of, I guess, intermediaries and service providers, means that those middlemen, or what the tech industry likes to call rent seekers, effectively out of a job, right? Because the asset owners are now deriving a return, and effectively technology is disrupting what they're performing. And I think we're going to see what's happening right now with DEX's develop virtual marketplaces for a significant number of traditional asset classes in the world, and whether that's eventually gets to equities, and there's lots of regulation that needs to be anticipated on that front, or just spot FX, forward FX, traditional futures markets. And obviously, my background is commodities, and I have a very soft part of my heart for that sort of space. And I think that's where I definitely see this moving towards quite quickly, and taking advantage of what has been the trade finance repo markets, and for the better part of 3 decades. So that's really what excites me today, and that's where we're sort of seeing it as a business, and really where we see a lot of growth over the next 3 to 5 years.
Great, thanks for that. I mean, you talked a bit about the relationship between DeFi and blockchain. Maybe Will, could you give us a sense of what kind of strategies someone involved in DeFi would employ to generate sort of that passive income?
Yeah, so there's a couple of different strategies. They're not actually that broad in terms of what you can do to generate returns, but the level of returns that you can generate within those strategies and the risks that you can take are significantly different. So the two strategies are effectively staking and yield farming. So staking is the concept of providing network security by staking a digital asset onto the native blockchain. So for example, if you took Ethereum and you stake your Ethereum for Ethereum 2.0, you basically provide a robustness and a security to the network. What that does over time is they will reward you and pay you back in their native token. Usually the yields and the returns on something like that are relatively low from a DeFi point of view, but you understand what you're going to be getting. It's pretty much a fixed return over a certain amount of period. So what you put in, you relatively know what you're going to get out. The other strategy is yield farming. So yield farming or liquidity mining is the concept of providing liquidity. And for this instance, let's just say US dollar stablecoins, by providing that liquidity into a decentralized finance pool or a smart contract, as John mentioned earlier. And you are acting as the capital for any outside parties that wish to transact for, say, object A to object B, whether it be US dollars to Aussie dollars, for example. If they want to transact, they would use the capital provided by the liquidity pool to facilitate that transaction. Those that provide the capital are effectively paid a transaction fee. And in the world of DeFi and crypto, those fees are, for whatever reason, they're basically regarded as a yield. But the reality is they're transactional fees. So I would say staking is really quite mundane relative to yield farming. Once you get into the realm of yield farming, there is a risk curve that is a lot more in-depth and sophisticated, that allows you, if you're a manager and you understand what you're doing, you're able to extract yields from 300 to 400% a year, and that would be in like a non-stable stable coin asset, to 4 to 5% a year in your traditional stable coins like USDC. So there's a plethora of opportunities there, and really I would say quite a niche sector at the moment in terms of actually having people out there that actually understand how to manage risk properly in that space.
Yeah, can I just expand on that a little bit more, actually? So one of the things Will mentioned before was yield farming. Obviously, there's staking, yield farming. When you get your head around what's happening in yield farming, that's where that back to your original question around disruption, sort of you have that sort of enlightened moment, right? And what I mean by that is what you're doing with yield farming is you're effectively pledging assets to a liquidity pool, and you're earning what a traditional exchange would retain as their profit, right? So if you think about, the SGX or the ASX that has transaction fees for managing the bid offers, the liquidity that forms part of those exchanges. What happens in yield farming and DEXs is the people that pledge the assets and use smart contracts to effectively balance what, in a bank we would call RWA or risk-weighted assets, are rewarded those transaction fees, because obviously the DEX is not a central organization that needs to derive a profit. So the disruption that comes from this technology is the fact that you're eliminating the need for that middle layer. And when you can understand that those transaction fees is what DeFi is rewarding the people that pledge the assets in the first place, obviously you need to understand the smart contract risk and all the other inherent risks that are associated with technology. But reality is we're transferring value from that rent-seeking middle layer back to the asset owners. And those asset owners are the ones, whether it's US dollars, Aussie dollars, Sing dollars, are the ones that end up generating return. And if you think about it broader, you step back, from the spotlight type concept, you recognize that you're actually generating a yield that could look like a bank account. And that's where, we start to think about it as a potential replacement for a lot of the services that are currently out there.
Well, what about stable tokens? What are these and what is their kind of role in the whole DeFi markets? You alluded to this a bit, but maybe you can go a bit deeper for our listeners.
Yeah, happy to take that one. So stable tokens, in theory, there's two types of stable tokens. One is an algorithmic stable token. One is a collateral-backed stable token. For simplicity, we'll just stick to the collateral-backed stable tokens. Basically, what they are is one USDC, which is $1 US, a digital US dollar, is backed by $1 US, in theory, sitting in the bank accounts of Circle. Circle is the company that issues USDC. So really what stable tokens do is they provide a form of liquidity to allow traders or institutions, whoever it might be, market participants in the crypto world, to exchange their maybe directional digital assets into a stable form of currency. So for example, if a speculator thought the market was going to go down, they would sell, say, their Bitcoin and they would put it into US dollars. And hence, they wouldn't have a capital loss on it if the market went down, because those US dollars are pegged to the US dollar itself, and therefore they remain and hold their value. But really what stable tokens do is they really are the backbone and the spine to the entire crypto market, because almost every single digital asset, to exchange that with anything else, it has to go through a stable token in some form. So they're super critical to the market. They're under quite a bit of scrutiny at the moment, predominantly out of the US and the Fed, and they're trying to regulate them. Our view is that they will regulate them, but in a good way, not in a way that it would cause long, continuous harm to the market itself.
Well, given this attention that's been shown to stablecoins, do you see that as the future of cryptocurrencies? Could the usage of stablecoins actually surpass that of Bitcoin, other cryptocurrencies, and also maybe fiat, the use of fiat?
Yeah, so they're very, very different, right? The value proposition from stablecoin to Bitcoin is like comparing a car to a tractor. They do very, very different things. The stablecoin purely is there as a form of liquidity on-ramp and off-ramp for any other digital assets. As I said, they are the spine to the ecosystem. Whereas Bitcoin's value proposition is that it is a finite, immutable, non-double spend asset that cannot be adjusted by any government or federal monetary policies to devalue the purchasing power of what the market gives it at the time. So they're very, very different concepts. In terms of surpassing, look, from a volume perspective and what is traded, absolutely. Stable tokens will always usually have the highest turnover, but as I said, I think the two are very, very, very different things.
Yeah, the other thing on that, Cheryl, like as Will mentioned, that you're kind of talking about two different monetary systems, right? So like obviously the stable tokens are underpinned by the existing dollars generated under existing monetary policies around the world, or monetary infrastructure. And if you look at, say, what the US dollar's done, when people talk about since they're leaving the gold standard, and the fact that you could argue the US dollar is not backed by anything except for obviously the GDP generated out of the US. And the US has the infinite ability to continue to create more dollars and obviously create inflation off the back of that, which is obviously what, somewhat what we're witnessing today, whereas Bitcoin is driven by a different monetary theory. So it's definitely not comparing apples with apples when you look at Bitcoin versus stablecoin, and they're serving different purposes within the ecosystem.
Well, thanks for that. I would like to actually move now talking about more of the risks of DeFi. And in addition to that, what are the sort of risks that are involved, say, in what you talked about with yield farming, staking?
Yeah, so risk is a big one, and that's something we have spent a lot of time looking at and getting comfortable with ourselves. So the risks in DeFi really revolve around smart contract risk. So when you pledge your assets to a smart contract, and you think of a smart contract as a piece of code that governs the intake and the distribution of funds. If that code is not completely tight or has particular vulnerabilities that may have been overlooked in the development of it, it's possible that they can be at risk of exploitation. And you would have seen that on many instances, probably in the last 2 years. It's definitely got better over time, but what we are seeing is the firms or these new decentralized exchanges that come out and put out liquidity pools, the ones that have rushed into it and haven't got proper smart auditing done on their code usually tend to end up being the victims of this. So, for example, if you look at like Curve Finance now runs over $12.5 billion. They're the oldest and the most battle-tested digital DEX in the ecosystem. They've never had one breach. They're very, very strict regimes as to how they manage their risks in their smart contracts, etc. So there is, and this is what I mentioned earlier, is there is an enormous scale here of risk, and really knowing or understanding those risks as well is super important. So, for example, we would, when available, we would take out smart contract insurance risks on some of our investments, and that's just part of our kind of mandate to limit risk further than what we think is already there.
Sure, thanks. And maybe moving on to something that is perhaps on the tip of everybody's mind, given the sell-off recently in the crypto markets. What are your thoughts around this, and where do we go from here? Yeah, so massive sell-off, and look, that's really been across the board, right? On the whole idea of inflation and the Fed getting much more hawkish. People are predicting, 3 to 4 interest rate hikes during 2020. I personally think it's a little bit heavy-handed at this stage, but bearing in mind in FY22 in the last 22 months, 80% of all US dollars in existence were printed. So there was an enormous amount of capital that has come into the market. Inflation has obviously started to creep up. I think the US are doing this quite well. They're probably hiding what the real true asset inflation is.
So I think their CPI number was around 6.4% from memory. Markets across the board took a hit. The Nasdaq's down 20%, Bitcoin's off almost 50% from the highs. What I'm really looking for is to see the eventual decoupling of Bitcoin predominantly, because it is the kind of inflation-proof, or that's its value prop, inflation-proof monetary system. I'm looking for that decoupling from the equities market. So when you get an instance like this, what the Fed has done, I think over the next 1 to 2, hopefully not 3 years, but I think it's coming relatively soon. We're going to start to see a decoupling of predominantly the Bitcoin, Ethereum market from traditional financial markets like the S&P and the Nasdaq, and I think once that happens, it'll be hard to hold it back.
The only other thing on that, Cheryl, is obviously we have a pretty uncertain macro environment in general, right? We've got a lot of geopolitical risk around the world right now. So, obviously what's going on between Russia and Ukraine, even what's going on in Abu Dhabi, which creates a lot of nervousness in markets. And obviously what we've now seen is, I think Will said 2020, but I think he obviously meant 2022. The Fed very nervous about moving from what they previously, I guess, marketed as transitory inflation to now what is real inflation. And that real inflation they have to tamper with, right? So they effectively have to raise rates. And effectively the market is definitely pricing 4 rate hikes in 2022. That naturally, obviously, shifts a big sell-off in macro environments straight away from growth into value. And we've seen a lot of managers do that. And I think crypto in general, because it is a growth story still, right? I mean, you are inherently, a lot of these projects are about growth, and disruption can get bucketed with that. Now, sometimes people misunderstand some of the utility of things like Bitcoin versus other crypto assets, and naturally you see a bit of a correlation, one move. But until we get some certainty around, which is actually, Wednesday this week when the Fed meets, and I think, in my opinion, more than likely, you'll get a lot more clarity around where they'll be from a rate environment standpoint. That will probably temper the uncertainty in markets, temper the uncertainty in growth stocks. You've seen things like Spotify drop by 50%. Obviously things like Block drop by more than 50%. So while Bitcoin's come off, all the major tech stocks have been absolutely slammed in the same regard as what we've seen in crypto. So people talk about the Nasdaq being off 15, but I mean, the major tech stocks have had the same sort of implications. So I think we're in a very uncertain environment. I think with the midterms this year, there's going to be a lot of political pressure not to force the US into a recession, to tackle inflation, despite the fact that the Fed is talking about a bit of a hawkish move. But you need to put it in perspective. I mean, four rate rises this year, what are we at? 1.5%. We're still pretty cheap money. And it's cheaper money than 99% of the world's experienced, through their entire investing career. So for me, it's a bit of a reset on everyone's mindset around how central bankers are operating. And you've got to realize the ECB, for instance, has already come out and said, we're not changing our QE policy. We're not raising rates. We continue with our asset purchases. So we're talking about one central bank, being the US, obviously a very important central bank, but it's arguably, I think it's being overly mispriced today from a macro standpoint. And our view is these sort of opportunities are great trading opportunities. And you see great traders take advantage of these opportunities historically.
And how has you seen all of this impact what we're talking about today, the DeFi markets? How does it change what we are talking about? Does it change how you would invest?
No, not necessarily. So, what we're talking about here is extracting value from the DeFi ecosystem. So, people talk about speculating on Bitcoin, Ethereum, Solana, whatever, Phantom. Yes, they go up and down 30%. You can lose your capital in 30% in a couple of days because they are volatile assets. But, what we're talking about with DeFi is extracting the transaction value, right, of assets changing hand within these DEXs and then being attributed back to the asset owners in the first place. So from our perspective, if the whole ecosystem was to, I guess, lose the enthusiasm from a developer standpoint, from a continual commercialization standpoint, yes, there'd be less transactions. So those transaction fees could potentially drop and we'd earn less, from the pools. But it doesn't impact us today, right? And what we continue to see is a very, very bullish environment, both from a developer standpoint, from a commercialization of this core technology, and also the participants who are getting involved, right? You're seeing, major asset managers continue to pile into this space over the last, 3 to 6 months.
Yeah, well, some would even say that DeFi is the next frontier of the global financial system. Do you agree with that? And what are the key features that you think DeFi has that makes it the future of finance?
Yeah, I think the reality is that there will be some financial systems and infrastructure that cannot just rely on DeFi. So I think the ideal world would be a kind of a hybrid between both. What that looks like exactly, I don't really think anyone knows yet. But what we do know is the amount of infrastructure and work that has gone into all the ancillary services that are getting built up around that. The system itself being DeFi by major banks, broking houses, etc. It's something like I've never seen before. It's quite difficult to keep up with the amount of growth there. But in terms of what will DeFi be in the future? What I think it will be is, and this is what John alluded to earlier, is now with DeFi, you as an individual are able to participate in a reward system for offering up your assets that you would otherwise never been able to get access to. So if you put your money in the bank now, I'm not exactly sure what it's like in Singapore, but here, I think you'd struggle to even get 1% on your money. And the way that I think about that is, I know that the bank, for example, would be generating more than 1%, but due to all of their operational expenses, wages, fees, etc., that earning they make gets heavily compressed, and that the ultimate return to me ends up being 1%. In DeFi, when you pledge your assets, there is almost zero overhead costs and OPEX, like compression of those yields. So what you're getting, and this is what, as I said, John mentioned earlier, is to some extent the true yield or the true value of a transaction between two parties that you've helped facilitate. So look, I think it definitely has a massive future, and I think once we start getting into liquidity pools and DeFi for traditional finance, whether that be the commodity market, larger scale lending solutions, etc., I think I think it definitely has a bright future. For example, I recently bought a house, and part of that loan I took out from DeFi using digital assets as collateral. And if you'd mentioned that to someone 2 years ago or 3 years ago, just no one would have believed you. So, look, I still think there's a lot to get through, but it's definitely come a very, very long way in a very short amount of time.
Yeah, and Will, the interesting thing on that is, a lot of regulators around the world are moving pretty quickly to create the framework for that to move forward. Right? I know obviously here in Australia, there's been a lot of positive momentum from Senator Bragg around how to look at things like DAOs, and how do you actually consider a DAO, because it's not covered by the Corporations Act, right? So if it's not covered by the Corporations Act, how could it ever have a tier one's market license, for instance, to operate a virtual marketplace for a stock exchange? So a lot of work needs to be done to understand what is going on in DeFi, and I think politicians, I think regulators, legislators are all running around right now, recognizing that this is a quickly evolving space, but it is the future, right? We're part of the Digital Finance Cooperative Research Centre, also in Australia, which is a government-funded research institute. It's got $120 million of funding, which is alongside major participants like the RBA and Macquarie Bank and all these types of players, around researching the future digital economy and how people will interact in the future using things like smart contracts, understanding how, Will borrow, buy a house with his, digital assets as collateral, and all these sorts of things which will become mainstream. You won't know what's happening behind the scenes, I think, because you end up with a UX which will look and feel just like your current bank, but their role will be diminished, I believe, dramatically.
Yeah, so then any guesses, this is a question that came on the chat. Any guesses as to the percentage of DeFis that's actually applied to real world applications rather than applications for, say, trading of cryptos and other cryptocurrency market related applications?
Yeah, I mean, I'd say it's very little today that's applied to real world applications outside of crypto. I think obviously crypto is the main marketplace for what is supporting DeFi, right? And so, but then you've got to understand that crypto is not is supporting real world applications, right? We did the world's first public blockchain token with a government guarantee, and that's on the Ethereum blockchain. We do provenance solutions for carbon scoring and tracking physical assets on the Ethereum blockchain. We have to pay gas fees for that, right? Those gas fees are paid in ETH. So we're supporting the, real world application of these assets using the Ethereum blockchain, paying in gas fees, which is a commercial use case for paying in ETH. At the same time, we're then using Ethereum DeFi pools, right? So yes, you could argue that there is a lot of trading, and I think, the majority of the activity right now in crypto is definitely speculative, right? Obviously, people are like, similar to all of the, I'd say profitless technology stocks out there. There's a lot of, thoughts around Rivian, for instance, replacing and, the combustion engine, pickup market in the US. And yet, it's a $100 billion company, which has made about 10 cars. That's similar to some blockchains and protocols where there's a lot of activity and developer activity building real world use cases, but they haven't got there yet. Not saying it's all like that, but there is that still speculative component to what happens in this space.
Yes, so maybe going through some of the questions that came in on the chat, and thank you so much for being participatory. What is the most important criteria you think you would consider when you are evaluating any DeFi project? Maybe, Will, this is something for you in terms of the strategies that you employ.
Yeah, so I would say the most important thing is understanding who are the creators, which inherently can be quite difficult sometimes, just given the nature of crypto and the anonymous way that some people like to go about their business. But I would say a couple of things. So understanding who has done it and what their track record is, the amount of assets they have locked up in their pools, the smart contract auditing firms that have actually audited their code and how many audits have been done. And going back to what I said earlier, there is also, a scale of what are the good smart contract auditing firms and their reputation that follows them compared to some that are average. And so you've actually got to understand who it is that is looking at the code. Thirdly, I would probably say understanding what they're doing. So there's a different couple of ways that DeFi works. One, when you invest into something, say like Yearn Finance is a multi-strategy DeFi pool whereby they go out through their own diligence and invest in multiple strategies and basically aggregate those returns and those yields and return that back to yourself. Whereas if you look at, say, some pools on Curve Finance, it's a lot more mundane and a lot more simple to understand where the risks lie. So there's definitely a bunch of different opportunities there, but you just have to understand really all the intricacies and the risks that are attached to each of them.
Yes, and going into maybe some of the questions around stable coins. So we have one around what is the role of stable coins? Why do people need them? Why not transact directly between US dollars and cryptos or other fiat currencies and cryptos? Why do we need stable coins there?
Yeah, so that there's really two ideas there. The first one is it's not just as simple to always exchange in US dollars. There's licensing regulations, which really is a huge point for exchanges to offer direct transaction into US dollars. My understanding is there's significant reporting requirements that surround that, and they must be adhered to. At the moment, US dollar digital stablecoins fall outside of that realm. So, you know, when you've got a very much a growing industry that grows so much faster than regulations can actually keep up with, transacting in only US dollars or continually converting to US dollars becomes inherently restrictive on the growth of the entire ecosystem. And that's really how US dollars stable tokens took off, really with USDT, so Tether, originally.
Okay, so we also know that stable coins are not created equally. Like, why would you think USDC is more of a trusted token versus USDT, or what are your views around those?
Yeah, so that's definitely a good question. US dollar stable tokens, they in themselves have a range of different risks depending on what you go into. Some are very safe that we would consider, such as USDC. We know that they are heavily audited, very transparent in the collateral that backs them. You can then go all the way down the line to US dollar neutrino, which is somewhat opaque and depegs frequently from the US dollar, with a low market cap, low liquidity, etc., etc. So, and that's just the stable tokens that are backed by collateral. There's also algorithmic stable tokens that are backed on basically code and the idea that if there's an opportunity to be arbitrage, there will be arbitrage that step in to rebalance using the mechanism that holds an algorithmic peg to keep that peg. So, you know, we look at a universe of about 12 to 15 stable tokens. We have our own in-house views on them, and we allocate in our funds proportionately to how we perceive those risks. But we definitely err on the side of caution, I would say.
Just Cheryl, also back on the first question, you know, why do you have tokenized US dollars, right? I guess is the main question, or tokenize any form of fiat currency versus just trading pairs of crypto assets. If you want to participate and to build this ecosystem where you can actually interact with things like DeFi, it needs to be tokenized, right? So the smart contracts need to have a tokenized asset actually inherently embedded into it. So as we've seen, you know, the whole growth in stable tokens, yes, originally it was done because it was like nearly a digital on-ramp. So, you know, people would take Sing dollars, US dollars via centralized exchanges. They would come on, right, by a regulated platform. They could be converted into tokenized fiat currency. But then those tokenized fiat currency are then in the ecosystem alongside all these other crypto assets and can interact in real time with these assets as well. So it's quite important to realize that you can't interact with these systems in a, you know, having a Swift system plugged into, you know, a DeFi ecosystem. And that's, you know, coming back to sort of CBDCs, you know, central bank digital currencies, which, you know, we're inherently involved in, you know, that's a big part of that as well, right? I mean, those CBDCs are digitized currency. You know, different governments around the world are looking at them in different ways, but inherently they'll be anabranched to enable them to interact with the central oracle being the central bank for them to interact with a lot of these other ecosystems that are developing, and, you know, back to virtual marketplaces, whether it's in crypto or tokenized commodities or tokenized securities or tokenized funds, it will allow all of those marketplaces to both a private or public blockchain to be completely efficient and be able to operate.
And just going through the questions, Will, I think you had mentioned earlier talking about the traditional markets and inflation, how that had an impact on the cryptocurrency markets. So one of the questions that came in was when or why do you expect this decoupling to happen between these two markets, and why do you expect it in the next 2 to 3 years?
Yeah, so what I think this really will be the holy grail for crypto, and when I say crypto, with reference to this particular point, I mean Bitcoin, and purely from the idea that its ability to not be printed and to be a finite store of value, to truly act as that store of value, is when, if we see that the Bitcoin price movements decouple from how equity markets are moving in a time of high inflation, that's, in my mind, that is when we will start seeing the validation of the theory that, the reality is that Bitcoin is the hardest currency ever created, right? Like, that is the reality purely by the facts and the code of how it operates. But it's still probably in its growth phase and adoption phase that that theory hasn't actually come into reality, whereby it doesn't always, its price movements are inversely correlated to an equity market, which, can be pumped up on the idea of just continually printing money, and can be dragged down on the idea of the Fed raising rates and on the back of inflation. So that's kind of where I feel where we're at now. I don't think, I just don't think that the market is quite there yet to play along with this notion. I think it's probably about a year to 2 years away, but I struggle to see how it won't happen.
Sure. And maybe talking about trends and themes, we have the in 2017 the theme of ICOs. In 2021 last year it was about NFTs. What kind of exciting themes do you see this year going forward?
Yeah, I think obviously that there's the big one, right? That's been very, very busy in the last probably 4 months. The whole concept of the metaverse, and you have some of the largest companies in the world like Facebook changing their name to Meta, etc. I think that is a huge topic, a massive concept, but still incredibly, incredibly early in its evolution and where it's going. My quick perspective on that is you're going to have a clash between a decentralized metaverse, whereby the individual owns or physically in a digital way owns the assets that they buy, whether that be the land in the metaverse or in-game kind of assets where you physically own them, versus corporately controlled metaverses like Facebook's, eventually when they created their metaverse, where, I'm sure it will be great, but the root of it is that you don't actually own any of the assets you may have in there. They'll all be owned by Meta, the company itself, and any fees or any monetary value that is generated will effectively go back to the shareholders of Meta, which is completely the opposite to a decentralized metaverse, like, for example, the Sandbox or decentralized. So I think that is going to be a massive point going forward. The next point, I think, for 2022 will be the scaling of layer 1 solutions. So the scaling of Ethereum, Phantom, Solana. You're going to have this battle of layer 1s that are really going to be able to scale to sizes that are so large whereby they become inherently attractive to the market for scalability. So you're not going to have these systems that get clogged up with high gas fees like Ethereum is now. They, for example, Ethereum is supposed to be launching Ethereum 2.0 next year, but the other part of this story is the ZK rollups, which is effectively the layer 2 solutions that are being built on top of Ethereum and other layer ones that allow for much larger and to some extent infinite scaling capability of these systems. And once that happens, you effectively have the bedrock to allow mass adoption at a very quick rate and basically to be run very inexpensively, which currently is not quite the case.
Sure, and maybe going back to what you spoke about earlier, John, you brought up the concept of DAOs. Perhaps for the benefit of some of our viewers and listeners who don't know about this, could you talk a bit more about what it is, how it's and how it's relevant to our discussion today with DeFi's?
Yeah, sure. So it's a DAO is a decentralized autonomous organization, and effectively that organization is to some degree like a not-for-profit, right? Like it has a number of members that can dictate what will ultimately be the terms of the underlying organization and what it will operate under. And when I was referencing it before and talking about it from a virtual marketplace standpoint, a DAO can, obviously function these virtual marketplaces and dictate, what sort of assets can be allowed in, which assets meet a minimum threshold. In the same way, you could consider an exchange member, right, dictating it. And so if you looked at an exchange like the CME, you have assets like, corn, wheat, soybeans, all these old agricultural products that have, thousands of different deliverable grades of the underlying asset. It can come into that exchange to create one commoditized asset. The DAO members, in theory, could be the voting members of an overall commodity ecosystem, all the different commodity players around the world that hold the underlying DAO token that could vote to create what would ultimately be the deliverable grades. So you're giving back really the power or the control, right, of how these organizations are run to the people that actually own the underlying asset in the first place. They're obviously used right now for like thousands of different other purposes. I mean, you're seeing DAOs being forked, particularly off Olympus, left, right, and center. And, some of these have folded, particularly in the recent sell-off. Some of them, have tried to create arguably, Ponzi schemes. And I think this is one of the major issues with crypto in general is as many great and fantastic concepts and solutions that are being developed out there. There's a dime a dozen of poor projects that potentially can take investors' money, right? Because people don't really understand the underlying technology or understand what the solution or project is actually trying to provide. And we did see that in DAOs, like back to your what was a big thing. DAOs has been a very hot topic, for regulators as well. Back to I was saying about Corporations Act, but for me, it's actually one of the most exciting things that I think is going to come out over the next 12 months is DAOs being used for real world marketplaces and real world applications and major corporations around the world being those participants. But when I say major corporations, I mean the people that actually generate GDP, right, in the economy, not the ones that are sort of sitting and taking that sort of middle slice.
Sure. So another question about how the markets, we might be going to what some might call a crypto winter. So for some of us who hold cryptocurrencies as investments, what are more interesting ways that we can still gain yield from our holdings?
Yeah, so again, back to what I mentioned earlier, there is the staking side, and as I mentioned, the output of the rewards from staking is somewhat known. They're relatively stable over a long period. However, a lot of people that enter the market want more than 4% or 5%, annualized. They want north of 10% on their money. And so, again, that's where yield farming comes into it. And look, I think regardless of crypto winter or not, there's definitely still going to be opportunities in the liquidity mining yield farming space. It would probably be slightly more difficult to hit your targets. However, there's definitely more and more strategies coming to light now, and a lot more opportunities out there that allow for sophistication in your trading techniques to extract value, but at a very low risk. So, you know, a lot of people look into hedging positions, and there's a whole bunch of different stuff you can do. However, yeah, it's obviously not quite as simple as that. But look, I'm not particularly concerned, regardless if the market is in a downturn for a while. I'm pretty confident we can still kind of hit our targets. And if, you know, this month there's anything to go by, then yeah, still feeling quite confident about that.
Yeah, and the other thing, I mean, you can look at it a completely different way, right? I mean, I think we've moved on dramatically from 2018 and, you know, the last crypto winter, right? And if people believe in those cycles, that's fine. I'm not personally a believer. I don't think we have enough data, right, personally, to be able to say we have these cycles of winters and summers or whatever. But for me, reality is you create value. You do projects in this space which are innovative, are generating real returns for investors, creating opportunities for developers to get actively involved, then, you know, there's a huge opportunity here. I mean, there's so much going on. It's quite hard to, you know, hit the nail on the head what the next big opportunity is, because there is so much going on, whether it's digital art, what sports organizations are getting involved in, what's going on in the metaverse, gaming, from a game to play, virtual marketplaces, DeFi. All of these are real world applications. These are all real things that are underway today. And depends when you say, you know, where do you put your money? Well, are you saying, do you want to bet on the direction of an underlying crypto? Okay, sure, that's obviously one thing. You know, as Will alluded to, obviously you can extract transaction dollars, but don't forget that, you know, this space is, as an ecosystem, as a community, couldn't be moving any faster. And I've seen, you know, I can't say who we've hired on this call or anything like that, but, you know, we're getting the brightest minds and the best people from the best industries all joining it, and it's only going to get stronger and stronger and stronger, and that's where I think we're heading.
Sure. Well, something else that's been talked about is total value locked. Could you maybe explain more about what this is? How does it actually impact yield farming?
You're on mute, Will.
Total value locked, or TVL, basically is the idea of how many assets are locked up or have been deployed to smart contracts to provide that liquidity we were talking about that facilitates an individual or a party transacting within a pool. So total value locked from 2020 or late 2020 was around 300 million. And this was just kind of at the inception of DeFi. Right now, last time I checked, which was about a week ago, the total value locked across all liquidity pools was over 300 billion. So it's obviously grown very, very quickly. I think within this year we're going to see the TVL get probably up to $1 trillion. So that's, you know, about 3.3x from where we're at now. I think that's definitely achievable given how fast everything's grown and really how much work has been put into the space from other institutions, asset managers, custodians, brokers that weren't even there, you know, 2 years ago. As John mentioned earlier, the whole landscape has just changed so quickly that if you don't keep your eye on it, you kind of miss how much has actually gone on and how large some of the players are in the space. But, you know, the short and short of it is TVL really is a representation of the health of the DeFi ecosystem. If there's no assets pledged to the system and into liquidity pools, then trading really isn't achievable, because if you try to trade anything on size, your slippage will be immense because the liquidity won't be there to facilitate that transaction. So it's a healthy thing. You could look at it similarly as hash rate is to the Bitcoin network. That's probably a good proxy.
Sure. Well, we're coming right up to the end of the hour, so I think we have time for just one more question. What are some of the skills that are necessary and high valued in crypto asset management firms like TCM compared to other traditional investment banks? Yeah,
so here's a good question. So I came from a more traditional investment bank, probably a bit more of a private equity house. But for me, I think financial modeling is definitely helpful. Not in the sense of understanding M&A modeling, etc. You know, it's more about if someone says this is a large piece of data and this is what we need to be able to build systems that allow you to monitor your trading position. So effectively PMS systems, and that's what we've had to do here. You know, as I said before, quite a lot of infrastructure hasn't been able to keep up with how quick our operations are actually moving. So we have to build everything in-house. I would say that is one part of it. The other part is, honestly, I would say just the attitude and the willingness to learn and want to be there, because, you know, unfortunately, it's quite difficult to get time off, or like actual time off. The markets are 24/7. So if anything, you know, goes haywire, I'm pretty much at a beck and call, which is fine. But you've just got to really enjoy the space, and you've also really got to buy into the idea of what you're working with. So I'm fully sold on where you know, that not only the technology is going, but also some of the individual utility value propositions that some of the tokens have, and very, very interested to see how that is going to interact with, you know, the future of traditional finance going forward.
Sure, and that's all the time that we had for questions. What we will do, and I know there's been some questions that we haven't answered, so if you have further questions, please just email them to Alex. That's alexanderlee@addx.co, and we will try to answer any remaining questions offline. Thank you so much to our speakers, John and Will. Thank you for joining us, everyone that's on the webinar. We will see you very, very soon on our next webinar. Thank you, everyone, and have a very good evening.